Good morning, good afternoon, and good evening, everyone. Welcome to the Refinitiv Perspectives live stream. I'm Keesa Schreane. London Interbank Offered Rate, or LIBOR, is one of the most widely used interest rate benchmarks globally. It is used to value products such as mortgages, bonds, derivatives, and even personal and corporate loans. After finding key improvement areas within the LIBOR, working groups such as Alternative Reference Rate Committee, or ARC, in the US, for example, are now engaged around recommending a more sound and sustainable replacement. And now we're seeing a transition from LIBOR to alternative risk-free rates globally. Now, what makes this all very interesting is the fact that about 300 trillion US dollars is tied to the LIBOR globally. So there is a need to have clarity around what this transition means for global markets. To discuss this with us is Vince Dimase, Sales Readiness Director, Trading and Banking, and Jacob Rank-Broadley, Head of LIBOR Transition Benchmarks and Indices at Refinitiv. Thank you both so much for joining.
Thanks for having me.
Thanks.
So Vince, with almost 10 months to go, how prepared is the financial market to make the LIBOR transition? And let's talk about some of the key challenges in its path right now.
Yeah, well, thanks, Keesa. Thanks for the question. It's definitely not an easy one to provide a unique answer on the state of play of the LIBOR transition. As you correctly said, a few months to go, almost 10 months to go, and everybody is looking to get ready, right, in time or well before. Definitely, the ubiquitous nature of LIBOR is such that this project is big. It's a massive undertaking for the full industry. And if you accept the analogy, it's just like a big boat trying to change route or direction. So it takes time, it's a big effort. And to further complicate this, it's not just one single boat, it's several boats, the different jurisdiction, each with its own speed and trajectory and technique to complete the migration on time. If we look at the market and what is happening, definitely the ISDA fallback rates kicked in, the term rates started to appear on the market. So it's a good indication and a good proxy of the process moving forward. If we look at the new risk-free rates adoption in terms of its liquidity, it's a mixed scenario with some markets still not adopting a lot the new risk-free rates, and we can see still a minimum component of contracts linked to risk-free rates to SOFR, for instance, compared to USD LIBOR, while this process is different and faster, maybe in the UK, possibly in the UK, where SONIA was a more established rate. All in all, I would say the transition towards the risk-free rates is well underway across the industry, and we can foresee a further acceleration as we approach to the end of this year.
So well underway, although there are lots of factors, lots of countries and involvements that could really bring about a slower change. I love the ship analogy there. Jacob, talk to us about term rates that Vince just mentioned in context of implications for investors specifically.
So these are alternatives to LIBOR. These are designed as being forward-looking, which is a key factor. So forward-looking nature of LIBOR is one of the key elements that people use in their infrastructure today. One of the points that Vince touched on was these overnight rates, which are replacements, and that's operationally quite different. And so these term structures are much closer to a LIBOR type functionality, but act as a replacement to the benchmark. So you may be familiar with something like a 1 month or a 3 month or a 6 month term rate. This tells you the cost of borrowing for that period in the future.
Okay, great. And where are we in terms of the British pound LIBOR transition? Are certain currencies prioritized here? And what are the key milestones?
So from the pound sterling perspective, GBP is the furthest progressed within the transition. If you take a look at any of the data that's available, the pound sterling is doing very well. It's well on track for the end of this year. So a few points to note. One, the expected cessation date for GBP Libor and many other currencies is at the end of 2021. Life isn't that simple. It's not a matter of keep using Libor until the end of this year and then switch over. There's a series of interim deadlines. So the first of those that's key is at the end of this month. So at the end of Q1, firms should stop using GBP Libor in new issuance of loan products and new issuance of linear derivative activity. So that's going to be a key milestone for people really to switch across, and we should see a big jump in activity from that point. The next milestone to watch out for is at the end of Q3. Same milestone, type of milestone, but it applies to non-linear derivatives. And then that leaves one final quarter for as much stuff which is legacy contracts. So these are instruments that have already been issued to move across. And then by the 31st of December, firms should be ready that if Libor isn't published on the 1st of January, there won't be any operational issues.
Wow. Okay. So, wow, lots of benchmarks and milestones happening between now and end of the year that we need to look out for. Vince, what is the term SONIA? I'm bringing in the SONIA benchmark. And what is the difference between what we're talking about now and the term SONIA in terms of the role that it's going to play?
Yes, it's a good point. And yes, there are structural differences between SONIA and the term SONIA. I would start saying that SONIA, the Sterling Overnight Index Average, is administered by the Bank of England. The SONIA was introduced in 1997, then the Bank of England took responsibility in 2006, and then the SONIA was reformed in 2018 to match the OSCR principles and the benchmark reform ideas in principle. It's a risk-free rate, so SONIA is a risk-free rate, it's overnight, and so it lacks that term structure that Libor is bringing in. On the other side, the term SONIA is administered by a private benchmark administrator, and it's a term, comes with a term structure, exactly with that forward-looking structure. Refinitiv launched term SONIA in July 2020 as a prototype at the very beginning, and now is live in production as of January 2021. And normally those term structure come with a specific tenors, normally 1, 3, 6 months, and 12 months. So the main difference lays in the overnight nature, in the term structure of the term SONIA. But never forget the main alternative to Libor in this case is the risk-free rate, is SONIA, right? While term rate can serve specific segments of the market.
Okay, great. And so I'm just going to repeat that because I know for some folks that could be just a little confusing. We have the SONIA, which is the risk-free rate overnight. And then we have the term SONIA administered by a private benchmark administrator, and it has a term structure. So if we're looking for the alternative, we're looking at the risk-free rate there, correct?
Correct. Yeah,
okay.
The main alternative. Yeah.
The main alternative. Great. Okay, so in terms of where term SONIA rate will be used, or is it being used now? Could you talk us through the rollout, what's happening with it, and where it's going to be used, Jacob?
So that's a key point. As Vince said, the overnight rates have become the de facto standards. But the overnight rate operationally is very different from a Libor style benchmark. The lack of this term structure, the lack of the credit spread, these are all superficially seem quite easy elements to deal with, but actually operationally, this has been embedded into financial services systems so deeply that actually making those changes are incredibly complex. And what we've seen in the derivative markets is we've got very sophisticated participants. They're used to making changes relating to kind of issues like this, and it doesn't represent a big barrier. But there are other participants in the market or other products which it just doesn't warrant going through all of that hard work, and it's just not a sensible approach. And so for these markets, the term structure is the preferred alternative. In different jurisdictions, and we'll come on to those in a minute, think about this in a different way, but the UK and the GBP market, which has really been the leader in the space, has been very prescriptive in what they think is a suitable market to be using a term structure and what they don't think is suitable. In January last year, they launched a white paper, and that looked at possible use cases for which it would be valid for using the term SONIA benchmark. In that, they identified that it'd be very appropriate to use it in the loan market, particularly in emerging markets, in SME lending, the smaller end of corporates. They also thought about use in things like transaction banking products, so things like trade finance would be suitable. And then the highlighted products like Islamic finance would be suitable. And that's either because the cost of making that switch is disproportionately high, or because there's products like in Islamic finance or like with trade finance products, they actually need a term structure. Without the term structure, they can't work. And so in the UK market, I think that's where we're going to see the adoption. And we come into it a little bit, but when we've been having conversations with customers, there's been a lot of focus around either wealth management divisions or private banks, or the transaction bank, which is where they see this as a cornerstone element of that transition.
So that term structure is very clearly I guess the key point there that will help us to make the decisions or help those decision makers choose which direction to go in. And talking about this, how does Refinitiv create the term SONIA benchmark? What goes into that?
So that was a lot of work that we did with both the regulators and our customers over the course of 2020. We spent a lot of time looking at the market, analysing what options there were, and also taking the advice from the working group that was put out through their consultations that they did. The benchmark that we produce, we use data from 2 electronic interdealer clubs, where we source SONIA OAS pricing information. We take a 20-minute window centered on 11 o'clock in the morning, and we repeatedly snap the data from those venues in order to build up a snapshot of what's going on in the market. We then put a series of filters over to make sure the data is good quality, and then we produce the rate based on the median value, which is a similar approach to that's used in software. Now, in the unlikely event that there's a drop-off in liquidity, and one of the really interesting things about when we created this benchmark was we actually commenced testing it about a year ago now, and that was just as we were leading up to the volatility when the COVID crisis began, and that showed us the performance of the benchmark in a stress period. And it did demonstrate under periods of extreme stress, there can be a possibility of a drop-off in liquidity in that market, and it's really important that we have a robust methodology. So what we built around it was a waterfall methodology, where if there is a drop-off in liquidity in the dealer market, we can then use a backup source of data, which is the institutional market, very similar data sets, works in a very similar way from a methodology perspective, but it tends to be more persistent during periods of stress. And that ensures that in those scenarios, we can still produce a rate. Now, if we see an absolute extreme event, and we haven't seen anything like this so far, I guess in theory, the institutional market could dry up as well. And then we have something called the integrated fallback, and that is based off SONIA, and it applies the difference between the SONIA rate and our previous day's rate moved forward by a day, and that ensures that just as long as the Bank of England produces a rate, we can still produce a benchmark. So we have both that benefit of being really accurate and also being really robust during periods of extreme stress.
Great. So,
if I can, Keesa, just one point, because the methodology aspect is very important, both in jurisdictions where the selection needs to be done by the market players. So we are getting more questions and interest from the market players into what the methodology is about, into the details, so that they can judge. But also similarly, this is a valid point for those jurisdictions and those areas of the market where the selection will be made by a committee or a working group, where the relevance of the methodology and the quality of the data, how robust is the data, will definitely makes the difference in the selection process and the adoption of those term rates.
So in describing how this was produced and the role Refinitiv played and how you worked externally, it sounds like some of the testing, some of that, resilience testing that you did was really where there was room for improvement with the LIBOR, which is why the LIBOR is being transitioned. Is that fair to say that you've tested this term SONIA in a way that we won't see those same issues that we saw with the LIBOR in terms of those areas of improvement that were needed, that really were the background for this transition?
Yeah, so we spent a lot of time really thinking through those risks, and manipulation was a key factor that led to the demise of LIBOR. So as we thought through this benchmark, there's some key elements. One, the data we source is from the swap market. The use case isn't designed for the derivatives markets extensively. So we almost eliminate the benefit from that trader of even considering manipulating the rate. Beyond that, the checks that we do in terms of it's not a submission-based benchmark, we source it from regulated venues. So that adds an extra layer of robustness. We then remove any outliers that don't pass our checks in terms of volume or spread. We have requirements around taking the median rate, which means at least more than 50% of the values would need to be manipulated before it have any impact on the rate at all. And so through all of these factors, we then reduce the risk of manipulation. And then on top of that, which is relatively standard practice, we run surveillance and monitoring on a T+1 basis to check for any abnormal behavior. And then that acts as an extra level of support. So that's been an absolute key factor. And then in terms of the design process, we launched a prototype, as Vince said, in July. And that prototype was tested for 6 months by the customers. I received great feedback from that. There were some really minor changes we made based on some really good feedback, but it just demonstrated that with so many customers looking at it, testing it, that it was really doing its job.
Now, Vince and Jacob, there was a lot of work to put this in place. How widely is this actually going to be used with all of the work that went into it?
Sorry, in terms of that was how is it going to be used?
How widely is it going to be used?
How widely is it used? That kind of comes back to the point we were talking about previously, in the fact that it is very much targeted towards specific markets, being the trade finance market, being the loan market. Now we're still relatively early days, but we've seen really positive adoption of the rate so far. In terms of since we've been commenced testing it, there's more than 800 individual firms that have accessed the rate via our Icon platform. We've seen lots of firms trying to integrate it into their feeds. So well over 100, probably more than 150 customers have integrated to their feed products. And then actually we've seen quite a lot of customers use it via the website. Some firms just find it easy to go and click and download the rate from the website. It's been great. We've had more than 400 users on the website access it, which I think is phenomenal for a currency like GBP. We're not talking like US dollar here. So that's really positive, get that level of adoption so early in the process. And there's still a long way to go till we get to the end of the year and people need to be fully transitioned away from GBP Libor.
Great. So lots of use cases there. You talked about that earlier, emerging markets, SME lending, transaction banking, et cetera. And it's being used via feeds as well as website access. I'd like to put another term out there in terms of a term rate. Will there be a term ester rate? And Vince, if you could just talk us through the differences between what we know about term SONIA and term ester, and then what the future of term ester is going to be.
Yes, definitely. The ester stands to SONIA, just like the European market stands to the UK one. So we are talking about two different jurisdictions. The ester is the euro short-term rate, which was introduced a few months ago, almost more than 1 year ago. In terms of what is going to happen to the ester rate and to the availability of the term ester, I would say the short answer is yes, right? The term ester will be available, and just like what will be happening in the UK and compared to what is happening in the US, in the European Union, the rate, the term ester will not be selected by a committee, by a working group, but will be selected by the market. The term ester will exist, should exist, and obviously this is subject to the availability of a private benchmark administrator, and Refinitiv has got plans towards that direction. And obviously this is always subject to the availability of underlying markets. So enough liquidity, as Jacob mentioned before, which applies to all jurisdictions, enough liquidity to calculate a rate which is robust and solid enough. Obviously, the term ester, when it comes in, can be used also as a fallback for Euribor. Right? Euribor will stay, and that can be one of the usage of the term ester.
And in terms of, you mentioned that there's a different jurisdiction for term ester than for the previous term SONIA. What are those separate jurisdictions, or what's the difference there?
Well, we're talking basically the euro short-term rate compared to the sterling or to SONIA. So two jurisdictions, the European one and the UK, basically, which are similar in the way they will select the term rate, and different to what will happen in the US, where there is a different path to be followed.
Perfect. And so, given the Libor isn't widely Euro Libor, the use of it, as well as the Eurobor, hasn't gotten a clear, I guess, secession date at this point. How will the term euro short-term rate, so Esther, how will that be used given where we are with the secession date, where we are with getting things approved?
That's the key question. I think that's what everyone wants to know. Euro Libor is just not material. The usage is essentially trivial when compared to Euribor. So I think it's very unlikely we're going to see a term Esther rate being really widely adopted this year as people prepare for the Euro Libor cessation. If personally I needed to transition something, I'd probably use Euribor, which then leads to the question of actually where is the term Esther rate going to be used? And really it's being positioned as the fallback to Euribor. So once Euribor then ultimately ceases, which we don't have a date for, then it will be used. Now the key question is, where will it be a fallback rate? And here there was a paper which was launched, a consultation paper launched in November last year. And unsurprisingly, the recommendations from that paper were really consistent with the work that the UK did around the use of the term SONIA benchmark. So all the same stuff that we just talked about, the loan market, trade finance market, potentially some niche markets. And they also raised some interesting questions around kind of use of funds, which I don't think has really been explored very much in the UK market, but it ultimately could be a really valid use case.
Great.
Yeah. And if I may, Keesa, just to complete the flow on the European jurisdiction, another recurring question that we got between the end of the year and the beginning of 21 was exactly the future of beside the future of Euribor that Jacob described perfectly. There are no plans to terminate Euribor so far. The other question was around Ionia. What will happen to Ionia? And the path for Ionia is exactly the same that was planned. So we can expect the Ionia to be discontinued as of the 3rd of January 2022, or better, will be discontinued as of January the 3rd of 2022. And this was reiterated many times by EMI, the European Money Market Institute. And the EMI also encourages the switch, right? The acceleration in moving and transitioning from Ionia to Esther. And at the same time, it's encouraging the use of Esther in any new contract, especially the new ones which are maturing after the date when the Ionia will be discontinued, which is, again, the 3rd of January 2022.
Such tremendous information, and what a great job you did packing this into our short time together, talking about the transition from LIBOR to alternative risk-free rates globally. We start off talking about the SONIA risk-free overnight rate versus the term SONIA, which is administered by the private benchmark administrator, and the difference there being the term structure. The risk-free rate is the primary alternative that we're discussing here in terms of the transition. Also talked a bit about Esther and the differences there, and the fact that Euribor is not necessarily moving away right now, but term Esther may be a fallback for your IBOR. Such great information, and we look forward to continuing to read about this expected transition that's looking to happen at the end of 2021. Excellent information. Jacob, Vince, thank you for joining and sharing the details with us.
Thanks to you.
And if you want to learn more about our LIBOR and IBOR solutions, you can get more information by typing the link or scanning the QR code on your screen now. Feel free to connect with us on LinkedIn, Twitter, and even Instagram. Let us know your thoughts on the live stream. Thank you so much for joining us. I'm Keesa Schreane. Be well.